Good morning, folks. Please let me know if you can hear me. Good morning, Vishwas. Good morning, Kingpin, Amar, Kushal, Mr. Trehan, Krishnan. Good morning. Good morning, Ayush. Thank you, Krishnan, for confirming. Good morning, Supriyo. Good morning, Swapnil. Good morning. My request is please don't call me sir. Please call me Alok. Um, I don't think I've done anything special to, be called a sir. Hello, Kiran, Bhavin, Mani, Medevi, good morning. I hope the last month's intra dip in the markets has not unnerved anybody here. I mean, this is part and parcel of the market. I don't think many people who have come into the markets in the last 4 or 5 years have seen any dips actually since March of 2020. So it has been 4 years of virtually either up markets or sideways market. Virtually no situation of even a 6 month. Yeah, Medvi is saying when the dip happens, ab yaad nahi rehta hai. Yeah, so people have forgotten that markets are part of their risk portfolio. Market is not confirming that they will continuously giving you returns on a weekly, monthly basis. So yeah, I mean, the old lessons get learned again and again in the markets. There will come a point where nobody will, touch the market with a barge pole also, and the cycles will repeat. So in the last almost 30 years uh, that I've been in the markets, there have been so many cycles, so many situations where euphoria and total disappointment have played a relay race one to the other. Uh, and I was at a conference yesterday. Respected Mr. Nilesh Shah was also there, and a couple of other good speakers were there. And I was very surprised to see that everybody was talking the same language what we talk here. Let your winners run, cut your losers, have a structured strategy, do asset allocation, uh, invest in different stocks and double up on the ones that start doing well. So when I hear this coming from a lot of value investors and conventional investors, I feel very nice that you know common sense is becoming more widespread and mainstream, and uh, and there is learning for everybody that is happening. So I think we have a good quorum now to start. Let's start the monthly roundup, March 2024. So Nifty is where uh, we probably, if you had made an assessment 1 year back where Nifty would be, uh, and last year if we were near 16 17,000, I don't think anybody would have made a claim that next year we will be at 22,500 from 16,000, 17,000. So we've come almost 5,000 points in the last 1 year, uh, probably more than 28% or so. But because we are already here, hence it seems that this is fair price. So why should uh, it go down from here? But that is not how things work. So we could be sitting at a very delicate position where election results are due, and some sell on news can also happen. FIIs have not participated much in the last many months. Domestic liquidity is what is holding the market. So while all is good, but everything seems to have been also discounted. So up ki bar 400 par is discounted. Fed will cut 2-3 times this year. That narrative is discounted. I personally think that may not happen, uh, because US markets are also doing well, and the US elections are second half of the year. So they will keep that ammunition of interest rate cuts to be done near the elections possibly, and not do it middle of the year. So there may be some disappointment in the middle of the year in June, July, if Fed cuts don't happen. And then of course earnings expectations are there, robust expectations are there. Whereas on ground we are already seeing autos are getting some discounting. So at least entry level or mid size two wheelers, four wheelers are getting discounts. FMCG companies, some of them are talking about mid single digit growth. So there are some dark clouds where this K-shape recovery of luxury doing very well, but that is a very small part of the market, and the general market not doing so well. The rural economy not doing so well, and again the specter of monsoon, how the monsoon will play out. It is always a very big joker in the pack for Indian market. So many variables are out there. The 200 DMA on this Nifty chart is 2400. So in your mind, we should always be prepared that market may come to the 200 DMA. And that is my way of sort of bracing myself whenever the market moves away from the 200 DMA or from any average. Like gold is moving away from the averages right now. Always think that, possibly some event can happen. It can at least bring it down to 200 DMA. Of course it can go much lower also. I'm not ruling that out, but what I'm saying is just to accept the fact that if things go bad, then you would have thought of at least some worst case scenario, or some scenario at least, so that the shock to your thinking is not so great. I mean, you will not be so disappointed then. If right now in your thought process you are saying that I'm okay if it comes to 2400 also, I'm sure it'll rebuild it back once again. On the monthly candle, you can see we are very much this trend, you can say, that started from COVID is very much on with with higher lows and higher highs. So this is very much continuing. The biggest pivot now is below 19,000 here. So the rally is very, very strong, and is robust in terms of its structure right now. On the yearly also, we are on the 9th year of a green candle, despite COVID 2020 fall, when which the year ended in the green in COVID, with nobody could have anticipated when COVID started that this year we will we will end with a green candle. Markets will be higher than where they started. So markets will always do things which are very, very unexpected, and whenever there has been a continuous multi-year sort of gains, the probability of at least one down year always increases proportionately or exponentially actually. So you can see multiple green years and one or two down years, then multiple green years, one down year. That will happen. So we need to be prepared for all those things. Monthly performance of indices, small caps took a dive in this last 1 month. So there was a reasonable dive of about 11% on small caps, and on mid caps it was about 5%, and the large and bank indices hardly fell. And but there was a very smart recovery on the index, and on the Nifty small cap index, and in many of the strategies also. And it was a sort of a uh, situation where your weak hands were shaken off, and once again, the build up happened after that. Small cap index, you can see here, after this, it had almost stalled here for 4 weeks at 15200, and then a major corrective action has taken place over the next 2 weeks, and in the last 3 weeks all the losses have been recovered. These small caps have now closed at a, an all-time high, and there is potential now that the new trend may start from here, so that potential can't be ruled out. Mid caps are already at a new all-time high, going up very, very strong. So maybe we are somewhere of an equivalent candle here, and this may happen post here now. But again, nobody can really say what's there. uh, Dollar index is very stubbornly stuck at 104. So the dollar index, which was being said that will fall, and emerging markets will get for overseas fund flows, that has not happened. So you are continuously seeing that foreign funds are their hands are tied, and they're not participating much in the markets on the buy side. Because the dollar index remains strong, the flows towards emerging markets are still muted. Another bogey that is gradually raising its head is the crude oil, Brent crude oil. We are now at $91, and I think once this top is taken out, if this top is taken out, it will become a narrative which will be sort of centerfold, and some worries on this front may start for our oil import concerns. So this is something that can possibly have some impact on the markets also. Gold is doing really well. I have been talking about gold since, I don't know, donkey years. Uh, and I always say that don't try to time gold, don't try to see what is the value of the gold price that is there. Just allocate. If you have zero allocation, allocate 5%. If you have 5%, allocate 10%. If you have 10%, allocate 15. And just today, this morning, I was reading a report in Wall Street Journal that uh, the young generation is are now allocating 17% of their assets to gold, versus 10% of baby boomers and Gen X generations. So millennials are doing far better allocation towards gold than uh, people in the previous two generations. So this entire narrative that mostly financial advisors, mutual fund managers have built, that you don't need to have gold, that gold maybe 1 to 5% in your portfolio, is all, I think, is not it's not a good narrative in my view. I think it's good to have a selling point for your product, but there it need not be a become a regressive point for other asset classes. I mean, if I am a provider of a small case service, I need not suppress gold or real estate or other asset classes because I want to more people to come and buy a small case uh, At least that distinction should remain in your narrative, that yes, you are offering something as a business, but then there is a perspective on other things also, and it should be a fair and practical and a transparent perspective, that people should be able to make use of those asset classes also. So my view has been this always, that uh, why should I not talk good about asset classes which I own, which I think will provide very good stability to your portfolios whenever there is distress. And believe you me, there will be distress at some point. This Goldilocks scenario cannot keep continuing forever. There will be distress, and then things will come back also. So to navigate that, those rough seas, this is sort of a counterbalance that is there. That is the only thing. In terms of sectors that we track in the last 1 month, media and IT have got smashed down. FMCG has been flat. Pharma has been up 1%. Energy, public sector enterprise, small gains. Then you had PSU banks at 2.7%, real estate at 3%, financial services. Autos did quite well along with commodities, 5%. Metals have come remarkably well this last 1 month, and gold has gone 10.5%. So this was the last 1 month's. Okay, sorry, I think there is some. Okay. Okay, sorry about that. So now I want to go through one strategy spotlight, uh, and it's very interesting actually. Nifty 50, index investing. We all know that index investing is great, and the index has been most popular, sort of a no-brainer kind of a thing. But I've done enough content now to also explain to you that index investing by itself is not a solution that can always perform. We've seen several countries after countries where index did not do well. Index will do well only to the point that the economy continues to do well, and the people who help in creation in index management, the creators of the index are able to creatively select stocks that continue to perform. So if the index management committee of the CNX board or whatever manages the Nifty does not select stocks that will do well in the next 6 months, index will not go up. Or if they select stocks that have huge weightage but are going down, then index will not do well, even if overall some sectors were doing well. So that's what I want to talk about here. That in 2008 to 2014, Nifty delivered zero returns. Of course, I've picked the top for to illustrate this. I could have picked the bottom and said that in 5 years Nifty gave so much returns, but somebody has bought at this point also. Nifty was bought at by somebody at this point, and he or she did not get any returns for 6 years. That is a fact. Now, let's see what happened during these 6 years. So, stocks and sectors within those 6 years. So, Nifty was up about 2.7% from January 8 to 13. Nifty Energy lost 29%. Nifty Real Estate lost 89%. Infra lost 58%. Public Sector Enterprise lost 41%. And PSU Banks 21%. And this is over 6-year period. So over 6 years, these sectors actually lost so much ground. And FMCG gained 168%, Nifty Auto gained 124%, Nifty Pharma gained 140%, Bank a little bit, IT 97%. So these four sectors were primarily the sectors driving gains, while these five, and actually banks also, six sectors were either flattish or negative for 6 year period. Now, and Nifty returned 2%. So if Nifty did not return anything here, and stocks like Sun Pharma were up 480%, HCL Tech was up 400%, TCS was up 352%, ITC 200%, Hero Moto 180%, Tata Motors 166%, Levers 136%. So these 7 stocks were up more than 100%, and they were all, of course, Nifty constituents, whereas Nifty was 0. So what is desirable? The desirable part is that I should be holding Nifty, and the more desirable part is I should be holding Nifty stocks that are performing. Why should I hold Nifty stocks that are not performing, which will cause my Nifty holding to be 0? Right. So, like you all know that the Nifty composition is so warped that 3 major sectors, banking and finance, and oil and gas, these 3 make up for most of the weight of Nifty. So like 39% weight is made up of this, and then rest is made up of all the other sectors. So, and IT also, sorry. So if these 2-3 sectors don't perform, then Nifty finds it difficult to perform because they are the heavyweights of the Nifty. And if the underweights of the Nifty sectors, like maybe IT, or sorry, cement, or infra, or pharma, if these are performing, it does not impact the overall Nifty because their weights are low. So the ideal situation is that you have stocks from Nifty in your portfolio, but you can equate them and you be the strongest stock. So that is what is done at India Top 10. This is a strategy that we run, and we have a special video that will come out on 7th of April. How this actually works. So there's more nitty-gritties to this particular kind of selection. And it's a rotational strategy, 10 stocks. It rebalances once a month. The recommended capital is 5 lakhs to 30 lakhs, and outlook for 5 years. If you have an outlook, I think it beats the benchmark most of the time. So we are running a campaign for till 10th of April on this, and you can use this code in case you are interested. FY2025 for India Top 10. So I'm at the end of my presentation here. I will open it up for Q&A. So it's 11:23. All questions that come in after 11:23, I will take them up, and we will see how many I can take up till 11:59. So Ayush has the first question. More concentration is more risk, is more return, and vice versa. Your insight, please make a video on this topic. Okay, we will try to do that. Some of the money says some of the weekend investing strategies select stock basis their rank in last 1 year. Isn't the 1 year period too long? First of all, your assumption that stocks are selected basis their rank in last 1 year is wrong. Second question is, isn't the 1 year period too long? Can the last 6 months ranking criteria stocks that have good momentum? So it all depends upon the design of the strategy. People can design their strategy based on last 1 month rank also, 3 months rank also, 6 months, 9 months, 12 months, or some other criteria also built in. It is not just simple ranking like that. And I think most strategies have done reasonably well. So, why sort of revisit a machine that is running well is my sort of thought on that. Sachin says, thanks for sharing your knowledge. You're most welcome, sir. Uh, Mr. Trehan says, HNI Capital Compounder is up by 10%. What are your views if one should book this profit and re-enter when some correction takes place? So, sir, my view is that the whole purpose of all weekend investing strategies is that you don't worry about timing at all. It may so happen that we may lose all 10% of that and go into minus 20% from here. It is possible. But the 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 the, the core thesis is that most people are not able to exit and then re-enter. But in case you feel that you have the ability to have the trigger at the right time, definitely you can try it. I mean, I can't say no because it is your money and your call. But my sense is that uh, when markets are dropping, the fear takes over our emotions. That, for instance, in COVID times when market was dropping, how many people were able to buy stocks? Very few. Actually, let's go one step before this. Why do markets fall? Markets fall because sellers are selling and buyers are backing off. Buyers are saying नहीं, मुझे को इतने पे नहीं खरीदना है अभी. And sellers are saying no, I want the money, I'm willing to sell here also. And they sell. And then at some one point of time, the buyer take over and they say, I am willing to buy whatever quantity you throw at me at this price, and I'm willing to buy. And then the sellers start to back off and other buyers say that I also want to buy, and it starts back. So it's an auction like process. And most of the time the auction like process is happening because the greed and fear is moving up and down along with it. So for most people, when market is falling, it is difficult to press the buy button. And for most people, when markets are rising, it is also difficult to press the buy button. So our ability to buy and time it is very limited. But some people have that knack for sure. So I'll just leave it there. That if you think you could, please, for sure you can do it. Uh, Krishnan says, once the strategy goes live, do you change the design of the strategy over the years based on new learning and developments? Can you please give some examples of design changes? Thanks. So Krishnan, since we have gone live in 2016, not a single weekend investing strategy has gone through any change whatsoever. We believe that the current changes that usually you see in many other strategies is because the frequency of their rebalance and the frequency of their review of the strategy in high frequency terms, or even in hourly or daily, there maybe there is some change that may have been required. But we are a very slow reviewing strategy. Once a week, once a month, nothing much changes actually over the years with this frequency. So while I can always go back, do curve fitting, improve certain parameters, tweak certain parameters, but I think that is a rear view mirror sort of driving that what has worked in the recent past, that bias should come into my rule book, which I'm not very open to that idea. I think what has worked well over a decade and is still working well, I would not want to, tinker around with that. That's my thought. But I mean, of course, I can be wrong on this. There is definitely more scope of improving. I will not deny that. If we are making 100% in a year, maybe if we did something, we could have made 120%. That is there. But as soon as you start to tinker with your rule book, then you have to go back and retest everything, um, and it becomes more and more of curve fitting. So when I even design strategies, I try to do as less of back test as possible and as more of forward step as possible. So like we did with HNI capital compounder that we launched recently, but the strategy was running for 2.5 years on small case, because we were doing that forward walk instead of doing a back test. And that gives me more confidence on the strategies. Next question is from Mr. Bhavin. If I purchase sovereign gold bonds from secondary market, will I get capital gains benefit at time of maturity? So my understanding is that if you've held a sovereign gold bond for more than 3 years and you hold it to maturity, you should be able to get the capital gain benefit. But that is my interpretation. Nowhere in the law does it say this way or that way. The problem is that the first tranche of sovereign gold bond came out in 2015 and or 16, and only in the last 6 months or so have the first maturities started to come, and those maturities will now go through the income tax assessment process, so another year. And then there may be cases in reference to these, whether income tax has allowed the market purchases to go to full capital gains benefit or not. So I think in another 2 years time, this probably is going to be more clear when there will be case laws on it. But as of right now, because gold as an asset class is long term in nature beyond 3 years, and on maturity, it is definitely in the RBI rule book that on maturity capital gains tax free will be there without reference to where the purchase is. So my interpretation is that if it is long term and if it is maturing, you should be able to get the benefit. Sudarshan says, how the HNI small case is different from other small cases. Is it market cap or extra services or return or capital protection? But when I think it should apply for each small case. So it is not different to the extent that, like one car engine is there, and then it can be tuned different way. So one tuning could be that you get 0 to 100 very fast. Another tuning could be that it doesn't go that fast, but it conserves some fuel. So the same engine can be tuned slightly differently for different need, and that's what the HNI products are also doing. The core engine remains the same as other strategies, no issues. And of course, some extra services, etc., are there, but those services are in some ways available to everybody. Maybe there is some priority listing for a support call or something like that extra there. But the tuning is meant for large capitals, so that more capital can be deployed. And mostly, most HNIs are also not looking for very high returns. They are mostly looking for more capital protection, or they are very happy with double digits, even mid-teens double digit returns. whereas most retail investors are not happy at that point. So things are tuned in somewhat in a different way for these segments. Roshan says, does your small case strategies allocate in gold? So we have two strategies. One is MI Evergreen, which allocates 25% of its capital to gold ETF, and that's a fixed allocation. So 25% is allocated, and then a month later, when we rebalance, the allocation is again set to 25%. So that goes that way. And then there is another strategy, which is a free strategy also, uh, where the gold ETF is married to the Nifty ETF in a equal weight uh, proportion, and on a monthly basis we rebalance that equal weight. That's all, very very simple. uh, so that strategy also is very good for, low risk parking of money. uh, it has, I believe, over the last 7 8 years, always uh, given some low double digit return, which is good for, that purpose that we're trying to solve there. Kushal says, Nippon gold bees or Zerodha's gold case. So currently we are using gold bees. The um, That has been the gold standard in ETFs. But as newer products will become more popular, then they become more liquid, we will certainly look at them. Sachin says, please share your knowledge in YouTube channel on a weekly basis. So we are currently reviewing our YouTube account again. Maybe in another month's time, we will start uh, using the YouTube channel again. Right now, I think we want to give more and more content to our subscribers who have, not only are using our app. So in case anybody here is not using our app, please download the app, because some very critical content about rebalances or some midweek upgrades can come there. So please use the app. So we want to, give our investors, the weekend investors, a privilege of having more content, and early delivery of content to them, versus put it out on YouTube. So there will be maybe a different kind of content for YouTube, but the exclusive content, the content which is very meaningful, we want to conserve it for our users. Lakshman says, how can I backtest the momentum strategy for conviction? So in case you want to know what tools to use, then I can tell you I use Metastock and ME Broker. These are the tools that I've used over a period of time. But these are archaic tools. They are like old generation tools. I'm sure there are a lot of new generation online on the cloud kind of services which are now available, which have the data also in it. I have to buy data from professional data providers like Global Data Feed or Viratech Feed, or uh, there are many other data providers. So uh, I'm sure there are other, uh, because for options, for instance, I know now that there are a couple of websites where you can put up uh, your rules, and they will quickly backtest it for you. I'm sure there is a lot of websites now for backtesting of equity stocks also. So, but I'm not aware of them. Sanjay says, any plan to launch top 10 momentum mid cap 50? Uh, we have studied this in the past. I think but we did not really get very good results on. But maybe it was not mid cap 50, it was mid cap 150. uh, so we will certainly, we are always looking for new products also, uh, so that we can create more niche products, somebody who wants to buy only mid caps or things like that. So we will definitely look at it, and whenever possible, certainly there will be more products. Sukhdev says, will there be overlap between NNF 10 and India Top 10? No, sir. So India Top 10 is exclusively based on Nifty stocks. So the first top 50 stocks is India Top 10 universe. And NNF 10 is the universe for the next 50 stocks. So Nifty Junior. Uh, so there is no overlap possible between these two. So, in fact, these two are a very ideal combination of strategies to have if somebody wants only large cap kind of strategies. Krishnan says, why top 10 recommended capital is 30 lakhs? If I love the strategy, why is it not recommended to invest more if the liquidity is high? So liquidity may be high, but number of people using the strategy can also be very high, and it may cause slippages. And because small case is a market order driven system where you press the order and it goes into the market, whatever may be the sell seller, you will get a fill, or whatever may be the buyer, your sell will get filled. So there is a certain uh, AUM estimate that we need to constantly have, so that see, every market, every product has its limitation of what money can play on it. Why do you think uh, California pension funds don't trade in India market? Because even if they want to put 1% of their money in India market will go up and down like that. Why do you think Warren Buffett does not have so much India exposure directly in stocks here? Because they can't get the volume that they require. So similar with everything, if there are a few thousand people who want even the most liquid stock, it will cause slippages. So at the cost of losing revenue, I sometimes have to even shut off new people from coming in, where we estimate that more people will cause more damage to themselves. It is damaging for me for sure, but even for the portfolios it is damaging. And from time to time we also have to close strategies. So like MI20 is closed, HNI Wealth Builder is closed, some other strategies may also close soon. So that's how it goes. सचिन सेज, आपके नॉलेज से मुझे बेनिफिट हो रहा है मार्केट समझने में. थैंक यू वेरी मच सर. थैंक यू सो मच सचिन फॉर योर वेरी काइंड मैसेज. Arjun says, why there is a max of I've already explained this. The day small case becomes a non-market order driven system, I'll be happy to increase the limits here. Divani Rahim says, hello sir, I have subscribed for 5 MI. Now I want to invest more in all the strategies, but not with the invest more options. I want to invest only in first 5 stocks of all strategies. So is it good math? So definitely, if you are a more evolved investor, if you are able to spend more time with the markets, studying the markets, you can build on these strategies. These strategies can be used as building blocks, and you can build your own layer of intelligence on top of it for sure. You could improve the dynamics of the strategy by having more, crisper exits, or you could pyramid up stocks that are doing well, which as a strategy provider we are unable to do. See, because I have to cater to thousands of folks, and not everybody has the same mindset to take on that kind of a risk. Like one user does not invest in our stocks. He just watches those stocks and then he builds his own strategy on top of that. So if we recommend 10 stocks, he will watch 10 stocks. Out of that, he will invest only in two, and then he'll pyramid up on those stocks and make a lot of money. So all that is possible. But as a strategy provider, my hands remain a bit tied. Deepesh says, in value strategies, we add more money when the market falls, but should it be the same way with momentum? I understand when the market falls, stocks picked by momentum falls more. So there are two aspects to this, Deepesh. One is that, as I mentioned earlier in the session, when markets fall, most people are stepping back from the market and not stepping into the market. Even when value guys say that buy when there is blood on the street, your own blood is also there on the street. So it becomes very, very difficult. What is possible to do is to allocate to momentum strategies, even if they are in cash. So let's say momentum strategy is in 30% cash, 40% cash, but you allocate to it, you add it to the cash. So whenever the cash gets deployed, you will get deployed automatically without having to go through that emotion कि भाई मैं पैसा डालूं कि ना डालूं. The whole thesis is that you should be able to do it non-emotionally. And if you are moving money into the market periodically or when the markets are down, then in your mind there is acceptance that yes, this money I have allocated to the market, now let the strategy take care of it. So you in a way disassociate yourself from the decision making, whether you should invest or you should not invest. So as soon as you move your money in, whether value or momentum, towards the market, and it may sit in cash till it gets deployed, then I think it really helps. At least for my investing, that helps in a very big way. Then I don't have to think in timing manner that market is down, should I buy, should I not buy, so on and so forth. So, and the other question, when market falls, stocks picked by momentum falls more. This is true to some extent, but then I mean it's like a yes and no answer. So in the very, very short term, like market is going up and it suddenly starts to fall. In the very short term, so first few weeks, you will find momentum stocks. I shouldn't say momentum stocks because there's nothing called momentum stocks. Stocks that were there in momentum, higher momentum at that point of time, fall more because more people were leveraged on them, more people were sitting in profits on them, so on and so forth. But as soon as this first wave is over, you will find that many of these stocks will stop to fall, whereas others will keep falling, because these stocks were going up for a reason, minus some speculative or some rigged ones, which are always few of them in the marketplace. But other than that, these stocks were outperforming for a reason, and that reason does not go away with the market crash. The reason may still remain. So what was outperforming before the crash may continue to outperform after that also. Yes, in those cases where some operator was rigging up the stock and has to get out, then everything that goes, the extent to which it went up, it will come back to the same extent. But in general, this diversion of strength that happens before the market goes down is an indication that something good is happening in that company, some advantage is happening to that company or in that sector, and that is why the outperformance was there. And that differential always is not, it does not come back to zero all the time. Some cases yes, but not all the time. I have a request to show you the code One user has requested to show the code. So FY2025 is the code, sir. Devani has another one. When we buy physical gold for investment purpose, how to calculate it? I mean, gold price plus making charges plus GST, it looks like we're already paying 6-7% more than this. Yes, so gold, physical gold buying and selling is not so efficient, both in terms of the efficiency of the transaction as well as taxation. So, but on the other flip side is that the gold you hold in your hand is actually the only true asset which has no counterparty risk. Everything else has a counterparty risk. If I hold a gold ETF, the counterparty is the ETF AMC. If I hold sovereign gold bond, the counterparty is the sovereign government, RBI. It may be safe. I'm not saying there is any safety issue, but I'm saying there is a counterparty. If I hold physical gold and I put it in somebody private locker, or even banks, my public sector banks locker, there is a counterparty risk. So what you hold or you keep in your house does not have counterparty risk. Everything else has counterparty risk. Now, some people like to have zero counterparty risk. Some people are happy to believe that the government will, step in whenever there is any requirement. So if the situation becomes very, very dire, world war breaks out, something like that, then maybe counterparties will run away. I mean, I don't want to make it sound very scary, but if some shit of that kind happens in the world, you will not have access to your demat account. You will not have access to your bank account. So, I mean, that's the extreme situation that you can think of. So, some people like to have some physical also for those reasons. Try to buy physical gold with the least making. So, don't buy jewelry. You can buy gold bars. Maybe you can get them for 1-2% making. So maybe 4-5% is what you'll pay. And if you're holding them for a decade, maybe 2 decades, then the impact on your CAGR is maybe like 0.5%, which is still digestible. So efficiency, yes, the efficiency point of view, there is no comparison. But in terms of risk, yes, there is a different risk perspective to that. Jamin says, if I subscribe to MIMT All Cap, invest high end amount of recommended capital within 1 year, then how to proceed for next 2-3 years, and I want to stay invested for 4 years. So if you exceed the recommended limit, that's okay. But my recommendation is that you don't exceed it by a large amount, because as a group, overall group, if everybody starts to do that, it will cause more slippages and it will harm the performance of your own. So if everybody sort of stays within recommended limits, because we are only able to estimate basis that how much more capital we can run on this, should we close the strategy for new users for recommended capital. So it is also good that, if you go by the rules, go to if you are near recommended limits, and next year if you, let's say, you make 30%, maybe you can take off 30% away from that strategy and buy another strategy, and you can also have diversification across different subsectors, etc., so on and so forth. So that's how I would play it. Shankar says, should I transfer the total amount of top 10 plus ATH holding if any slot available for HNI Builder at any point of time? So HNI Wealth Builder is a mid and small cap focused strategy. whereas top 10 is totally Nifty stocks, and ATH also usually will not have small caps. So uh, they are two very different buckets. So please evaluate the risk profile that you are looking at. I can't do it because the law does not allow me to do that. So if you have evaluated that you want to be in mid and small caps, you can let our team know whenever there is a slot available. They will inform you. But these two specific things that you have said are not the same segment of stocks. Mr. Mayur says, why don't you make a Nifty 10 Bs kind of instrument? It will make us easier for us and probably a little bit tough for you though. Uh, I'm not sure I understand. So we already have India top 10, which is a Nifty 10 stock portfolio. Um, if you're asking me to make a ETF, I can't make an ETF because ETFs can only be made by asset management companies, and to be an asset management company, we need some few hundred crores of net worth. So if you will be very generous and keep marketing for weekend investing, maybe someday we will reach there. Aditya says, what is your view on silver for upcoming year? So silver is something that I've never liked. Silver is that very volatile cousin of gold, which only wakes up once in few decades. And whenever gold is doing really well, so in years where gold will do 20, 30, 40% kind of moves, in those years, silver will be a rocket for sure. So this 2024, I think, is the year where silver can really do well, but it is pure speculation. I mean, no central bank is buying silver. There is no case for a monetary place for silver in the monetary system. Silver is a pure speculation in my view. Of course, it has industrial use and all that, but the move on silver is very, very volatile, and you need really, you need to have a very tough stomach to bear the moves of silver. So I don't like silver much for that reason. Harshad says HNI Wealth Builder is just like small case, but it is closed now. Investors need to rebalance, same as small case. Is that right? Yes, sir, that is absolutely right. HNI Wealth Builder is a strategy on small case only, and it needs to be rebalanced. Yeah. Gaurav says, can you think of coming up with one more small case which would be highly concentrated, having 7 to 9 stocks, weekly rebalance, rotational momentum, having highest risk and highest returns? We could do that. The costs will be very, very high. Number one, see, what one needs to also consider is that we will have a churn, a high churn, when we have concentrated stocks but weekly churn. And you will also need very high volumes because concentrated portfolio and some assessment of how much AUM will run on that. So it is possible to build high risk, high returns. I'm not sure if most investors would want that kind of strategy because, see, the average uh, investor with weekend investing is a person with an allocation of maybe about 10 lakhs towards a weekend investing strategy, is a busy professional, does not have time to look at the screen all day, uh, and is happy to do a few clicks once a week or once in a month. These very specific high risk strategies is more for folks who are already in the market at all times, possibly, and they want an additional sort of high risk component in their portfolio. So So I'll take your suggestion. I'll whenever we do go back to the drawing board, we will certainly take a look at these things also. Sharad has the last question. Uh, Gold is shining and is just starting. I understand from the post. Gold or silver? Any take? So I'm a biased person towards gold. I admit that. I think gold at 11.5% CAGR for Indian holders has been a remarkable asset class for all Indians. Even the poorest of Indians invest in gold. The poorest of Indians don't invest in real estate or mutual funds. The poorest of Indians invest in gold, and it has served them very well. 11.5%, and at that level people are not bothering about tax also. So 11.5% post tax returns is an amazing asset class which beats inflation, which beats you know most benchmarks by a wide margin. And the paradigm shift that has happened in the last few years, where central banks are now very much worried about this ballooning debt situation. USA is like at 130% debt to GDP, which is unsustainable. And if USA is at that position, many countries are in worse situation, because USA is possibly the cleanest shirt out of the entire thing. So the next decade will certainly have a lot of focus towards gold. Central bankers are buying gold left, right, and center. Gold production is not going up, gold production is going down. In fact, very recently I saw a photo of a gold mine. Just looking at that photo, you can imagine that gold is getting depleted, and it's only the repurchase and resale that happens is significant part of the volume that churns. But new gold out of the mother earth is not available. So it is getting scarcer and scarcer. And especially with this Asian mentality, we always buy gold, we never sell gold. We only sell gold when there is an emergency, when there's कहते हैं ना कि इसने गोल्ड बेचना पड़ गया इसको, so it's seen as a social stigma also. So I think gold investors will who are using gold as a hedge, at least. I'm not saying compare returns of gold versus stocks, because that is never comparable, but it will give you that fantastic peace of mind. And I know, because you are in the Middle East, you will get gold 15% cheaper from India also. So I don't have any more time for more questions today, but I'm sorry if I've not been able to take any remaining questions. We can definitely take it on in the next monthly outlook. I wish you all the best. I hope we have a great month. Elections would have started by the time we meet again next time. And hope that weekend investing strategies will deliver what you have expected of them. Thank you so much. Bye bye.